wanted to start with a broad question in terms of the outlook for rate hikes or cuts next year. Do you think it's fair to say that the bar for a hike is a lot higher than the bar for a cut?
I think that there's a bar on both of them. We've taken out some insurance over the last 3 meetings. We've taken rates down 75 basis points. I think that will provide a good stimulus for the economy. We're already seeing parts of it in housing and in auto sales. But rates take time to work. And so my inclination is to give rates some time to move, and then let's see where we are. I'm sorry, give the economy some time to move, and then let's see where we are.
In your assessment, President Barkin, is policy as we stand today still significantly accommodative, or is it neutral?
I think we're still accommodative, but that might be a pretty good posture in a world where uncertainty has been high.
You know, you have expanded the balance sheet significantly, a real reversal from what we've seen over the last couple of years. When might the Fed refocus on the balance sheet, or is this just a new normal?
Well, we did take the balance sheet up back in the financial crisis. I think that was a good thing to do. It provided stimulus for the economy. We committed at that time that we would take it back down to the minimum level we needed to conduct monetary policy. In September, you saw some issues with the repo market. I think that was a signal that we'd taken the balance sheet down about as far as we could, given the liquidity in the market today. So I think we're in a reasonable place right now on the balance sheet.
Well, do you think that the Fed can walk away from repo support after the beginning of the year?
Well, we've put some more short-term bills into the marketplace. We think that's steadied the market, and we hope that will steady it going forward. We're back at about the levels of early September in terms of the market, in terms of the balance sheet. But we'll monitor that and see how we do. We are committed to conducting monetary policy in an ample reserves regime, and we'll try to do that as best we can.
You mentioned uncertainty in terms of outlook going forward. What tops that list for you, and would a fully executed phase one trade deal remove the largest portion of that uncertainty?
Well, we have seen a lot of uncertainty over the last year and a half, and I do think that's been holding the economy back and is an important part of the case for why being accommodative matters. I think we have an opportunity here. The phase one trade deal should be helpful to reduce business uncertainty. The USMCA passage should be helpful to reduce business uncertainty. And I think some clarity on where we're headed in Brexit will be helpful on business uncertainty. And I think we have an opportunity here if we can settle the uncertainty in the environment to allow us to grow.
Could those things, therefore, alter your perspective in terms of whether we're likely to see a hike or a cut in terms of the next move? If all those things came together, would the outlook be quite different, quite positive for the economy in Q1?
I'm very focused on the data. So if the uncertainty reduction leads to increased hiring, increased investment, increased pricing, and therefore inflation, that will be a welcome change. And as the data changes, I may well change my outlook on rates.
You mentioned the calming of some of these trade tensions with China that we've seen and some clarity on Brexit. We have guests on a regular basis who talk to us about globalization may have hit its peak in the last couple of years, that we may see a reversal of this. How does that inform the Fed's thinking about economic growth?
Well, we do focus by mandate on the U.S. economy, but we don't ignore both the effect that global economies have on the U.S. economy and the effect that globalization has on the U.S. economy. And so we've had weakness in international economies almost across the board this year, and that's also been part of our story on why we thought some insurance made sense. And then we're also aware of the effect globalization can have on the growth of American businesses, on inflation, on wages. And we are trying to monitor as best we can the implications of an open economy on the U.S. economy, which is, of course, our focus.
But if in periods past where increasing globalization led to increasing prosperity, if we're stepping back away from globalization, does it lead you in any way to predict that we might be taking a step away from what has been a very successful period especially for the American consumer?
It is something to watch. I think it's hard to know at this point whether we're in fact taking a step back from globalization. I think, in fact, we have a new pact with Canada and Mexico. I'm hopeful that will lead to prosperity on both sides. We'll see what happens with China. But I do think most economists would say if you take a significant step back from globalization, that would have implications.
When you assess the U.S. consumer and the current strength that we're seeing across a broad range of measures, do you feel that that is reliant on the U.S. interest rate level and that it is only the case that the U.S. consumer is strong because the Fed has eased rates so significantly this year?
I think the major reason the consumer is strong is they have jobs. And not only do they have jobs, but real wages are up. Wages are up 3.1%, inflation's up 1.6%. That 1.5% gap is a real wage increase. And when you have jobs and your wages are up and you have strong savings rates and credit markets are open, that's a powerful stimulus to the economy. I think our rates moves this year have helped some, but they've helped in the context of what's been a very strong consumer all year long.
But clearly a lot of discussion always about where we are in the cycle. We're certainly not early in the cycle, whether we're late or not. Do you feel that the middle class in America has got structurally more wealthy over the course of this cycle? Or do you fear that when we get to a point where rates do go higher and stay higher, that the U.S. consumer almost one for one suffers during that process of rates moving higher?
Well, wealth has definitely gone up during this cycle. You guys monitor the markets more than I do. But I would say the biggest thing that's helped the middle class is jobs. And in particular, a metric I look at is employment to population. Employment to population for prime-age workers dropped significantly after the downturn. And in the last few months, it's actually gone back above its pre-recession peak. And that's the best thing we can do for middle-class workers is help them get jobs.
Mr. Barkin, you mentioned access to credit markets. Do you have any concern about the deteriorating quality of credit?
We watch that carefully. Financial stability matters a lot. It's hard to find much evidence of deteriorating credit quality right now in the data, but I think that's not something that you declare victory on. I think that's something that we're going to watch, and I watch very closely every month.
President Barkin, President Trump has tweeted regularly throughout the year about what he would like the interest rate position to be, and again, very recently saying he'd be so great if the Fed would further lower interest rates and quantitative ease. What is your response to that and those tweets? Are you just used to them now?
You know, Congress has given us the mandate to focus on stable prices and maximum employment. I think if you look at the numbers, you'd say we're doing about as well as any Fed has ever done. And I think my perspective is just keep my head down and keep focusing on the mandate Congress has given us.
But your colleagues and you, were there more tensions and more reactions to those sorts of tweets a couple of years ago than there are today? Is there a sense that this is now par for the course and the president can be ignored when he puts those types of requests out there?
I can't speak for my colleagues. I just say for me, there's always a pressure on the Fed. You guys cover us every day and others in the press, legislators, executive branch. There's always folks with a point of view. Even as I wander around my district, which is South Carolina through Maryland, at every meeting I'm in, I've got folks who have very good advice on what we should do. And my job is to listen to all the advice and try to do the right thing we can for the U.S. economy.
President Tom Barkin of the Richmond Fed.